Check us out to hear the latest on life in the volunteer state. Yvonnca and her guests discuss everything from life, love, and business with a Tennessee flair.
It's a Tennessee thing!
Always relatable, always relevant, and always a good time. This is Talking Tennessee, and now your host, Yvonnca.
This episode is brought to you by the Landes team, your go-to real estate family in East Tennessee. If you are looking to buy or sell, we are the ones you should call. Give us a call at 865-660-1186 or check out our website at YvoncaSellsRealEstate.com. That's Yvonnca, YVONNCA, sellsrealestate.com.
Welcome back to Talking Tennessee with Yvonnca. I am your host, and we have Chris Webb from Gateway Mortgage in the studio. Thank you for coming, Chris.
Well, I'm happy to be here.
You're happy to be here. We got some hard questions for you today. Are you ready for it?
I'm ready.
Okay, so let's talk mortgages. Let's talk what people need to know about getting pre-approved, what kind of assets they need, down payment, income. What is a debt ratio? A lot of people don't know what a debt ratio is. Even when their loan officer is saying your debt ratio is too high, what does that mean? Well, I brought Chris Webb in to tell you all the things you need to know on how to get your loan done and get ready to go to a realtor. Because going to a realtor first is a disaster. Going to a mortgage person first and getting your finances under control and knowing exactly where you stand is the key to successful closing. Do you agree, Chris?
100%.
100%. So, Chris, tell me, when someone goes to get a mortgage, what do they need to know? I know because people are so scared and they're so, worried about, fraud and all, people's like, well, I don't want to go to a mortgage person because I don't want to give them my social security number. First of all, it's secured, but what do they need to know?
Well, from a security standpoint, typically you're going to be getting a referral, often from your realtor.
Correct.
That has a trusted relationship, and if you trust them, you're going to trust that they're going to send you to the right person that's going to be doing the right things. But the things that you need to know before you call that mortgage person is you need to know, from a payment perspective, what is it that you're comfortable with? What kind of payment can you handle? Believe it or not, you need to know how much you earn. You wouldn't believe how many times somebody will call in and we'll ask the question, well, how do you get paid and how much do you make per year?
Correct.
And so many people say, I really don't know.
I believe that. People will know if you say, if it's an hourly employee, they can tell you how much they make an hour.
Right.
But a lot of people don't know how much they truly make.
Yeah.
A year.
And it blows me away, but that is actually the case. So, when it comes to what's relative to your income, we're going to ask you, are you on salary? Right? It's a base rate.
Right.
Or do you get paid by the hour?
Yes.
Are you self-employed?
Correct.
We're going to need to know those things. I'm going to ask you, okay, so if you're hourly, you earn an hourly wage, how many hours a week do you work? Is it 40 always? Is it variable? You might work 40 hours one week, 29 the next. It's kind of just up and down.
Some people think that if they work 40 hours, a couple weeks and 36 hours the other couple weeks of the month, they think, oh, it just averages that 40. You do 40 hours. No, that's not. You do 40 hours because you're not doing 40 hours. It's not an average out thing when it comes to that. It's just they do average out over a time span. But you have to understand that you need to know how much you make. You need to know how many hours you work and how you get paid. Keep going, Chris.
Yeah, for sure. Because if it's variable income, especially if you are relatively new to your job, and I'll define that as being less than 12 months. You're on a job that you've been at less than 12 months. If you're not working a steady 40 hours a week, that can create concern within
Yes.
underwriting, and we've got to ask for explanations and statements from your employer. So it's just really good for people, before you call your lender,
Yes.
go ahead and maybe get like your last 4 paychecks out, so that
That's a good idea.
you can kind of verify to yourself, yeah, I actually do work 40 hours at least every week, or 80 hours a pay period.
And then you can read it off to them exactly what your pay stub says,
Mm-hmm.
and they can get an actual amount that you can get pre-approved instead of having hiccups. A lot of people don't realize. I'm not saying that there's never lenders out there that change things. They shouldn't. Okay, but if your income changes throughout that process, it can change your pre-approval. Can you speak on that?
Yeah, 100%. If because we as lenders, we're going to take your application, go over your application with you, and anything we're telling you is based on what you're telling us, and
Correct.
the approval that we might give you is based on what you're telling us. And sometimes a person tells us one thing, and it's not that they're being deceitful. It's just that
That's what they think it is.
They didn't realize that maybe they don't actually work 40 hours
Yes.
every week. They work 37. And so if your lender calculates your income and your ratios based on 40 hours a week, and you're actually only making 37 hours a week on average, then that's going to alter that approval. It's going to alter what you may or may not get approved for. So it's really imperative that you be prepared when you call your lender. Go ahead and get your pay stubs out. Go ahead and get your bank statements out.
Yes.
Just in a general conversation, maybe even before you're prepared to make a formal application, you might want to just call your lender and have a general conversation. And it's good to be able to tell us roughly where you think you are with respect to credit and credit score.
Yes.
But
what does a lender consider a good credit score?
Well, it depends on the type of loan program that you're seeking. In the world of conventional loans, that top rung, if you will, is a 740 or higher credit score.
Okay.
That's going to get you the very best terms that are available.
Okay.
But that's quite a ways away from what's an acceptable credit score.
Correct.
So
what is, and I know that it varies, but what is, a minimum that you see out there right now?
yeah, I would tell anybody that is less than 620 to work as hard as they can to get that score up prior to making an application. 620
Yes.
seems to be a magic number.
Yes.
Something that we don't, at Gateway, we don't advertise so much, but the reality is we can go down to a 580 credit score. But
Yeah.
the reason that I don't go and tell real estate agents and people in general that, hey, we go down to a 580 is because truly the likelihood of getting approved at a 580 is very low.
Yeah, because there's a lot of factors to that.
Yeah. It's you can think of it as 620 and in 580 in certain
That's what I tell
circumstances.
my clients, 620.
And yeah.
And keep in mind, even down to, what programs you are approved for, that type thing, I can say this part of it is don't base your terms on somebody else in your family's terms, because everybody's terms are different. And so that's why you go to a lender. You go to a lender to find out what's my terms for me to purchase a house, because I want what is going to be made for me.
Right.
That type thing. Do you agree with that?
Yeah, all the time. Somebody will make application and maybe it's a younger person. Their credit isn't as established as maybe mom and dad's credit, and they find out that, their interest rate might be slightly higher than what mom or dad was able to obtain a month or two ago.
Yes.
But mom and dad's in a different situation.
Totally different.
They've got better credit. They've got, just a myriad
prior history of paying back somebody. And let me touch on that. The biggest thing you have to understand, and the more and more people, first-time home buyers I talk to, they really don't understand what it means. They're like, I want to buy a house, and I want them to lend me money. Here, let me give you my scenario. $100,000. If you had $100,000 in your bank account, okay, and someone came up to you, a stranger, Okay? No family member, no friend. Stranger comes up to you because that's what you are to a lender. You're a stranger y'all have never met. Okay? So you might have met them at an event, but that's not really knowing that lender. Okay? So if you had $100,000 in the bank and a stranger came up to you and said, I want for you to lend me $100,000. You're going to want something to guarantee the repayment. Because you're not going to give your $100,000 to someone that's a stranger that has never built a relationship with you, never had any history with you, never anything. You've never got to see how they work with their money, okay? You're not going to lend your $100,000 that you work so hard to get to someone that you don't know. Now let's go to lenders. Lenders no different than you. You have to look at that a lender is lending their money for you to get your dream. Their dream is not that house. Their dream is a relationship with you, but they need to make sure that they're going to get repaid. They want to make sure that your income, your credit history, and other things line up to give them a better look at, will these people pay us back or will these people default on it? And I think that's the biggest thing that people don't realize, because I think people come to you and like, well, I want to buy a house. Okay. Well, my credit score, and let me just tell you about this story. My mama was sick and my daddy was sick and this and that and that. And it's not that a lender is not sympathetic to those things, but all lenders are looking at is repayment. And you would be the same way. It's not that you wouldn't have empathy for someone, but you're still going to want to know that the money that you are giving, you're going to get back. Am I right, Chris?
Yeah, 100%.
Isn't that, I mean, that's how I explain to my clients.
Yeah, lender has to have confidence that you have a history of wanting to pay your bills, that the desire is there, that it's important to you. And then even beyond that, the lender's going to have to see that you have the ability to pay. And that's where we get into debt ratios, to make sure you're not overextending yourself or putting yourself in a position to not be able to repay the loan.
And so that's where you have to say to yourself is, okay, I want to go to this lender. I want to show him that I'm trustworthy. That's what you're showing them. Okay? I'm trustworthy. I'm in it to win it. I'm going to go to work, when I need to go to work, because I'm going to go make that paycheck so I can repay them. That's all you're showing them with credit and income. You're showing them, okay, I wasn't sitting on the couch chilling and not going to work. Even when on my off days or whatever, I went to go pay my bills to make sure that in 30 days, when the credit updates, that they're going to put good standings on me. That's what you are showing them, what your life is like when they're not sitting there. And so that's why you have to understand, lenders are your relationship builders that you want to build. They're not your enemy. And I want to stress this to people is lenders are not your enemy. Lenders are not there. I hear so many people say this, Chris. Gosh, they want to know everything about me. Even, the underwear I have on. And I'm like, that you would not believe how many times people say that. And I'm like, no, they don't want to know what underwear you have on, but they want to make sure that you're going to repay them.
Yeah, you're asking to borrow hundreds and hundreds of thousands of dollars.
Just stop and think about it.
And, I just can't stress enough to borrowers, relax with your loan officer. We, just like you, we want to get to this process. We want to get to the end of this process as soon as possible.
Correct.
We are not going to ask you for something that we don't need. If we're asking you for it, we need it.
Yes.
And
they don't just ask, and I'm glad you're touching on that, because a lot of people think lenders just ask, well, I don't need, why am I having to give them that? Well, I gave them something at the beginning. Wasn't that enough? Explain why sometimes y'all have to come back and things you may not have asked for at the beginning. What made you have to come back and ask for something different?
A good example would be that when we get the verification of employment back from the employer, from your employer,
Yes.
The way that they answered certain questions and some of the numbers that they gave us maybe don't line up with the picture that you painted for us on the front end.
Correct.
And again, it doesn't always mean that you're being deceitful or that you lied to us. It's just that
What you're thinking that you're making may not be the actual amount that the employer is reporting that what your income is, correct?
right. So in that case, we're going to have to come to you and ask for an explanation.
Correct.
A written explanation. And in some cases, we may have to actually get something additional from your employer explaining something. When you get into bonuses,
Yes.
commissions, anything that's outside the normal scope of pay,
Yes.
whether that's a base salary or a 40-hour work week, with these other types of income or other calculations within your income, that's an example of where we would have to ask for additional documentation.
Correct.
You give me some documents on the front end. One of the things I'm going to ask you for is your last 2 months of your bank statements.
Yes.
Okay. And you told me my bank statements have got X number of dollars. That I've got this much money in the bank, whatever. And then
A lot of people give those numbers and forget about what they debited out of their account about 2 days ago.
Yeah, that can happen. And so we give you an initial list of items. Hey, I need your bank statements, okay? But your homework assignment is not over as soon as you give us the documentation we asked for on the front end always, because you might give me those bank statements, and here is what we define in the industry as a large deposit,
Yes.
right? I'm used to seeing, every 2 weeks, $1,600 hit your bank account. $1,600 every 2 weeks. $1,600, and now all of a sudden there's a $3,900 deposit. I have to ask you, what is this large deposit?
Why do you have to ask that?
Yeah, we call that sourcing, and it goes back to the anti-terrorism bill.
Please explain.
As a result of 9/11, Al Qaeda and these terrorist groups, and in Washington, it became necessary. They deemed it necessary that we have to source all deposits, anything, deposits or assets that are going to be used to complete this transaction. We have to source it, and that's
that's a law. So it's not an individual, because I've heard this too, Chris. I've heard people, well, my mother, when she bought her house 30 years ago, she said she never had to do that. Well, your mom probably bought that house before 9/11, before the United States was under a terrorist attack. And they found out so much, funds came in and out of the country, that type thing, that shouldn't have happened. So they're trying to protect you. It's not about attacking you. It's not, they want to know everything about you, that has nothing to do with a loan. It's just that part of it is on a bigger scale. And if you read up on that law, you will understand it more. But I wanted Chris to explain that, because I don't want lenders to look like that they're just being messy. Because I hear that. You would not believe, Chris, how much that I hear buyers say, they're just being messy. I'm going to go to another lender. You could be leaving a really good lender just because you think the next lender is not going to ask you. Well, guess what? That law applies to everybody. So they're going to ask you the same questions. Am I right?
Yeah, it happens all the time. People get upset with their lender. I've fielded, I don't even know how many of those calls, and people are just disgusted with their loan officer because they ask, they'll call me and say, I don't want to deal with them anymore. They're just too difficult. But then I press a little bit. Well, explain that to me. What do you mean? What are you struggling with? And then I have to tell them, I'd love to have your business, but in all fairness to the other lender,
yes,
I'm going to ask you for those exact same things.
Correct.
People have to understand that when it comes to lenders, 95% of the loans that are made out there fall under the guise of Fannie Mae, Freddie Mac, FHA, VA, rural development. I mean,
Yes.
we all are writing the same loans, and we're all held to the same standards by all these agencies. We all have to ask for the same things, do things the same way.
Correct.
Some companies or banks are a little more efficient than others. Some may have lower closing costs or better interest rates or whatnot than others. But as far as what's needed to complete the transaction in terms of documentation and the questions that are asked, that's going to be pretty much the exact same no matter who you go with.
So many people are asking, Chris, gosh, these rates are so high. Should I wait? My opinion, and you can correct me, I'm going to give you my opinion. No, you shouldn't wait. No, because one thing you can stop is bleeding. And bleeding is spending money in an area that is not bringing you a return. Well, Yvonnca, what's that mean? Well, bleeding to me is if I go over here and rent a house, I'm bleeding out my checking account for somebody else's investment. But the day that you go and invest in yourself, you stop the bleeding and it becomes an investment, not a bleeding pool. The reason why I call it that is because it just runs down. Think of what blood runs down. Versus an investment runs up. Investing in yourself, you go up, 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 and up. And in a house, very easily, I've told my clients this, and they didn't think about this, Chris. They're like, with the rates being so high, I said, did you realize that you could get the house you really want right now? And then when rates go down, you can always refinance to get your rate down. And my clients go, I can? I was shocked at how many people that did not realize that.
Yeah, there's a lot of people. Yeah, there's a lot of people in the industry that are using this phrase right now, and it's very accurate and it's very applicable. Marry the house and date the rate, right?
There you go. Say it again.
So marry the house, date the rate. This is your dream house. Don't miss out on it right now because you think interest rates are a little bit higher than they were a few years ago. When rates come down, this is my 26th year, rates go up, they go down. There's cycles in, cycles out. People refinance all the time.
And if you only knew the kind of rates that me and Chris used to have to sell when we first got into business, these rates are not high. Mm-hmm. These rates are not high. Mm-hmm. Now, granted, let me make a disclaimer. This podcast, we do not Gateway nor Talking Tennessee quote rates. We don't quote any APRs. We don't quote any of that because what did I say? Every person has their own terms. So we won't be able to tell you, rates and all that. That's why I send you to a lender and say, hey, go to a lender and find out what terms that work for you. So we cannot quote any rates or APRs or anything like that. But go ahead, Chris.
Yeah. But no, you go ahead and take advantage of, right now rates have crept up, of course.
Yes.
So the market has slowed down a little bit, which
Yeah.
just means it's a better time to buy right now than
Correct.
it was a year and a half ago when everything was out of control. Go ahead and take advantage of that. I promise you, the cycle never stops. The rates always go up. The rates always go down. You buy something now, you're going to be able to refinance it. I don't know if it'll be 6 months. I don't know if it'll be 2 years or 1 year, but you'll have an opportunity to refinance that at a much lower interest rate down the road.
And just get with a lender. And I highly recommend Gateway. I do a lot of business with Gateway. Why? Because when I call, they respond. When I have a question, they answer. When I have a closing, they get it done. That's what it boils down to. And it's about building a relationship because I want my clients that when they call, they answer. Do you get what I'm saying? They answer the phone, they answer the questions, and they make sure that my clients get their keys. When I'm handing them keys, that means that lender supplied the money for you to get your keys. And Chris Webb is the area manager for Gateway Mortgage in Knoxville. And we've been doing business a long time. And I asked Chris, we always brainstorm about what's different in the market. And so let's touch on that. What are you seeing in the market on your end, Chris, that you can tell people about?
Well, like I said, we can't quote exact interest rates, but,
right? Are you seeing longer closings, shorter closings? Are you seeing more people, getting pre-approved less or higher? Or are you seeing, or is it still just a running course?
It's remained pretty flat over the last 6 months.
Okay.
Interest rates, of course, started rising last year, and they peaked around the first week of November.
Okay.
And that's when we saw the lowest activity in
Okay.
terms of new applications or whatnot. But the interest rates have started to trend back down in a favorable way. So we just, especially in the last 6 weeks, we've seen quite a few
More
people
applications
come into the market, and people seeing what might be perceived as a slowdown by some, and they're kind of trying to take advantage of being able to get a house on maybe a little more favorable terms.
Yes.
Because some people have stepped away.
On my end, what I am seeing is, Chris, and you can touch on this part, is that, with the rates, rates doesn't just determine if you can get a house. You can get a house on your pre-approval. It's just what you're wanting your payment to be. But the biggest thing is I'm seeing is some of the houses that are coming out right now, Chris, is that it may be out of someone's price range, or you have to be more realistic on your expectation on the house. So when you get to your lender, like once they tell you what you're pre-approved for, you may feel like you want 3-bedroom, 2-bath home, 2.5 bath home with a bonus room, basement. Because a lot of people love basements. I've got a basement. A lot of people love them. Okay. Some people like 2 stories. Some people like 1 levels. Okay. But I'll tell you, the biggest thing is that your pre-approval dictates what you can buy. And so your expectations in a house may be the 3-bedroom, 2.5 bath home, but what you get pre-approved for may not line up to what's on the market with that criteria. So what I tell people is, what is important to you? Is it more important to you to have your own investment, your own house with a lender that you can build a relationship with? And then maybe later down the line, if you outgrow that house, you can buy another house, because you can do that. Or is that half bath that more important to you than you renting and throwing that money away per month? And that's where I say I would rather give up a half bath and get that 3-bedroom, 2-bath home. Maybe I may have to tell my little sister, I'm just joking, my little sister, she needs to get out of the bathroom 30 minutes earlier for my makeup. You may have to do those type things, but at least you still have your own investment, because that lender is invested in you by giving you a loan, and you can always go back 3 to 5 years later or whenever, and you say, you know what, my circumstances different, my income's different, rates may be better, and I might want to buy another house. Then it gives you options. You can rent out that house maybe, or you could sell that one and buy another one. But it's about options. Do you agree?
100%. It amazes me when people tell me that are renting, we're just going to wait. We don't like where these interest rates are. But I'm thinking, and I'm often saying, you do understand no interest rate is as ugly as that rent payment.
That 100%. I put on my Facebook. I said, and like I said, I'm not quoting rates. This is a disclaimer again. But when someone goes on my Facebook and says, somebody quoted me at 6.5 rate. And I said, you do realize that you're at 100% rate on your rental. Do you know how many people that have messaged me and said, I never thought of that? They thought about the interest rate because, of course, over the years, it's a running conversation amongst family and friends on who's got the better interest rate. I don't know why, because everybody's terms is different, but it is. It's a conversation that people talk about. But you do realize that your family members that you're trying to compete with, their interest rate, they realize that you're at 100%, so they win no matter what. You're at 100% on someone else's investment. So you look at 100% at 6.5 interest rate. Well, it don't look that big anymore, and it's something of yours. So don't get caught up on them small details. That's what I call them.
Yeah,
Because that's a small detail to me. Because at 100%, all I'm getting is a pink slip, Chris.
If you could go back in time and take out an interest rate at, say, 3.5 to buy your house, and then you're looking at it from the perspective of, well, that same house now I'm going to have to pay 6.5. Well, that's 3 extra %. But with this market still being very healthy the way that it is, if your house appreciates at a 7% clip, you're still 4% net gain.
Exactly.
Versus if you're renting, it's just all a loss. And you're not gaining anything.
And let me say this: with the rates going up, I had a client, a precious client. We still are working on getting her house. And when she first started, she was pre-approved for $200,000. She said, "Yvonnca, I can't get nothing for $200,000." She's like, "Yvonnca," and I said, "You can get a house at $200,000. It may not be the criteria that you're wanting, but you can get a house at $200,000 even today." Okay. Well, rates went up, kept going up. I kept telling her. I'm like, when the rates go up, they do affect you. Okay. We have to get you pre-approved. Well, now she's at 150, Chris. She was approved at 200,000. That's why I tell you, you don't know by waiting. You hope that, if I wait, rates may go down. But say they go up, then you may qualify for even less. So that's why buying now, that's when you stop the bleeding. Buying now is what Chris is talking about. You've got the house.
And when you buy a house in today's world, that again, some people think, well, these rates have went up a little bit. I may or may not move forward. When you buy a house, and whatever that interest rate is whatever that payment is. And that principal and interest payment is going to remain a constant for the next 30 years. Yes. It's not going up.
Yes.
But what's going to happen at the end of your lease term with you and your landlord?
Guaranteed.
He's going to tell you, well, I got to raise your rent.
Guaranteed.
15%. So you have no security there. You have no comfort level that, I can either say my house payment's this much for the next 30 years and know I can plan around that. Or you got to cross your fingers at the end of every lease term that your landlord doesn't do something crazy and raise it sky high that you have no control over.
Moved Landes home and Turner Knox businesses because we were housing all the stuff at my house, and I had to go get storage buildings and all that stuff for a showroom and make a showroom. And the lady said to me, "Chris, that this is the rental amount." I said, "Okay." She said, "Now this is only for 1 year." She said, "It's subject to go up." That's the first thing that came out of her mouth. Houses are no different. Apartments are no different. But the good thing about owning a home is you're guaranteed that you've got a set payment on your principal. Okay? That it's going to be this amount. That type thing. I want to touch on debt ratio. A lot of people say, well, my lender said my debt ratio is too high. And lenders, if you're listening out here, and I know you're going to be, I think lenders need to do a better job at explaining what debt ratio is, Chris. Or clients need to really, really listen, because a lot of people don't know what debt ratio means. And when they hear high, they hear the word high, but they don't hear the other part. Can you explain debt ratio for me?
Yeah. Debt ratio in its simplest form is just the ratio between your gross income, pre-tax, right? Okay. And all of your debts. So debts meaning what's going to show up on the credit report. A lot of your monthly obligations don't show up on the credit report.
Correct.
Your electric bill, your cell phone bill is a couple of examples of obligations that you have and you pay on every month, but that's not part of our ratio. It's our ratio in the lending industry. It is what's on the credit report. So your car loans, your installment loans, credit card payments, plus this new proposed house payment.
Yes.
Right? So if you earn $4,000 a month and your new house payment's going to be $1,200, and you got a couple of car payments and credit cards that are another $800, that's $2,000.
Yes.
Well, that's 50% of your $4,000 gross income, and 50% just happens to be what is universally accepted as the ceiling for a debt ratio. There are a couple products out there that if you have compensating factors, which is typically a significant amount of assets in the bank, allow that 50% to go up a little bit higher. But generally speaking, 50% on like a conventional loan, that's the maximum debt ratio. Okay?
Now, when he said assets, I want to break this down so people understand. When he said assets in the bank, he's talking about your money in the bank. Okay? So your assets, so yeah, the more money you have in the bank that you can show that you've saved and you're this and you that, the better you look to a lender. Because you're showing a history of saving your money and not spending frivolously. Keep going.
Yeah, we want to see that, assets, reserves. You're going to get the benefit of the doubt to possibly have a little bit of an elevated debt ratio when we have a compensating factor.
Yes.
So we have a negative, which is your little bit high debt ratio, but that's offset by you have, enough money in the bank that translates to maybe 12 house payments or 3 house payments, whatever. You've got reserves. Those are what we call compensating factors. Another compensating factor is, hey, I've been on my job for 27 years. That shows extreme stability.
Yes.
So that person is going to be allowed to have a higher ratio, a higher debt ratio than somebody that's been on the job for 4 months.
Yes. Some people think that you can't buy a house, Chris, unless you've been on one single job for 2 years.
No, that's not the case at all.
It's not.
That's not the case at all. If you left one job and you went to work for another company doing something somewhat similar, heck, I don't care if you just started yesterday. That's fine. In some cases, we can be aware that you're changing jobs, and that's not even a problem. So you definitely do not have to.
They do want to see a 2-year history of employment, but it's not job driven. It's not you've got to be on this one job for 2 years before you can buy a house. And I think that's one of the biggest misconceptions of purchasing a home is they don't want to see these big gaps. They don't want to see you was on this job for 4 months, then you didn't work for another 10 months. Then you went to this other job for 3 days. Because that's not consistent employment. Remember, it goes back to the risk. They want to see someone that is working consistently because you're going to pay them consistently. So that's what it boils down to. And a high debt ratio means, I hate to say this, and Chris is not going to want to tell you this, so Yvonnca will say it. A high debt ratio says you're living above your means. You're making a certain amount, but you spend more than you make. And nobody wants to hear that. Nobody wants to know that they are overspending. But when you have debt ratios at 60 and 70%, I've seen people like 80-some%. That means that you are making X amount of dollars, but your debt is so much higher than what you're bringing in. So what does that mean? Go back to $100,000. Would you lend to somebody that you know that they don't make enough money to pay you? What would make you think that whatever they make, they're going to pick you to pay? When they haven't been able to pay all these other people, why would you think they would pick you? So that's why lenders have to say, okay, our ceiling 50% or below, because it's a better chance of you picking them to pay. Correct? Oh,
absolutely. And keep in mind, it's 50% of your gross income.
Gross. Not net.
You're not getting to deposit. If you make $4,000 in a month on your job, you're not putting $4,000 in the bank.
Correct.
Because you got taxes, insurance, Medicare, Social Security, all these things that are coming out of that check.
Yes.
So 50% is, it's pretty generous if you ask me. 50% of your
yes,
gross
because you're
income.
really higher than 50%.
Oh,
you
yeah.
really, if you factor
You're
in
probably
other
75%
things.
of your
Yes,
net.
yes.
Yeah.
Because, like he said, your utility bill, those type things, those are not factored in. Your phone bill, those are not factored in. Groceries, they're not factored in. So you're higher than that. So that's where debt ratio, get your debt ratio down. Let's talk about a credit card. Can we talk about a credit card? Mm-hmm. Okay. So everybody is like, I've got this credit card. Chris, my limit is $5,000. Well, a lender doesn't want to see a credit line of $5,000 and you owe $4,999. They don't want to see that, because what does that mean? It means that you're at the top ceiling of that credit card, and at any time, if something crazy happens in your life, you're at risk of not paying that credit card. That's $5,000. So go back to the $100,000. If you can't pay the $5,000 credit card, then how in the world are you going to pay a $100,000 mortgage? Do you agree?
Yeah.
Is that how y'all look at it?
Yeah. It's questionable to the human underwriter that's analyzing risk on these loans. And just if people don't know it, it reflects in your credit score. Having a maxed out credit card it takes a significant toll on your credit score when the lender pulls your credit score. So try to stay away from having a maxed out credit.
And try to stay away. My opinion, I did mortgages for 18 years, and I will always say this: if you're gonna have a credit card, stay away from department store credit cards, because I don't care how good you pay them or whatever. For some reason, department store credit cards are hard on your credit. They really are. And when I say department stores, I'm talking about my ladies and Dillards, the Belks and all those. It's better to have, to me, this is just an opinion, it's better to have a Visa that you use than if you use and I understand the Dillards and the Belks and all them give you all these incentives. But at the same time, those credit cards can hurt your credit, and when you go to get a mortgage, it may make you get higher terms. And when I say terms, I mean rates. If your credit score is lower than if you had a higher credit score. So be careful. Stay away from the department store credit cards. That's my opinion. Now, Chris, what do you think pertaining to credit cards?
Well, I think responsible use of a credit card is not always it's not a bad thing, but you have to be responsible with it.
What do you consider responsible?
Well, I really think that to take this down a personal road for a second, I put almost everything I do on my credit card, but I will also tell you I pay that credit card off at the end of every month.
Correct.
And I do it mostly because I get the points, right?
Yes.
That I get some rewards.
So we understand the points and all that kind of stuff. Now, granted, he's a businessman, and he needs all the write-offs he can get. And so it's better for him to do it that way, so it's trackable. Like, he can track all his spending, he can track everything. But the average person that's not a businessman or whatever, and that is not paying off their, and sometimes people say, well, I pay my credit card off every month. But if you don't have the access to money to do that every month, something can happen that you don't pay it off that month, and you can be in a bad situation. Versus Chris's situation is he's a businessman, and his is, there is a system to his, but he really does pay his credit. He pays that. We've had this conversation. Yvonnca, I don't do, and I'm a businesswoman, but I don't do that. Why? Not because I don't believe in his theory and what he feels is best for him. I just know best for Yvonnca. I don't want to put myself in a position that, I can pay it off next month. I'm in the business. I've bought a lot of people out of debt over my career, in financing, but I just don't, because I've been in credit card debt before. And I know how easy it can be, because a lot of people look at credit cards when they swipe it, they think that's free money. Credit cards is not free money. All credit cards is a term that gives you more time to pay. That's what it does. You gain terms on payment plan. Do you agree?
Yeah. If you're going to utilize a credit card in place of cash in the way that I do,
yes,
you better make sure that cash is there at the end of the month to pay off the credit card.
Yes.
Because if you're out here running
wild, he's saying already have the cash, not thinking, oh, the cash is going to come in.
This episode is brought to you by Landes Home Collection, the place where you can find home decor items, self-care items, and so much more. Shop with us and get the right things for you and your home at www.landeshomecollection.com. Enjoy the rest of this episode.
Because anything can happen. There's so many different factors to that. So that's why you have to say, okay, I've already got to have the money in, and I've got to have that consistently in my bank account before you do it like Chris does it. Chris pays everything through his credit card, and then he pays it off every month, but he's diligent about it. We've had many conversations about this or whatever, and Chris is like me and David. We don't do nothing unless our bills is paid. We're not going on a trip. We're not going out to eat. We're diligent about. I crack a joke about Y12. I got to pay Y12. Chris has got to pay Gateway. That's how you have to look at your mortgage. It's nothing more important than paying your mortgage. Chris, what do you think that the misconception of why people get so scared about investing in themselves? What do you hear people say?
I've been aware of many situations where people, a lot of it has to do with how you grew up. It's a generational thing. If mom and dad didn't own a house,
correct,
then nobody probably taught them about how to prepare to buy a house and just what that whole process looks like and why they should do it and why it's, it's the first step in building wealth is to actually own your own house.
It is.
And so I don't know. I think a lot of people just didn't have the right influences, but sometimes people are just scared of the whole process of buying a house.
And there is a lot of people that for whatever reason, I was talking about on my Facebook Live last night. I said, I didn't realize till the other day, Chris, I don't think I told you this. I didn't realize I am the first entrepreneur in my family. And I come from a very educated family. I come from a very successful family. With my grandfather and my mom and my aunt, all the accolades and all the things they've done in the community, and my grandmother, all of them did great things. My dad, everything. And then there came me, my brother and sister. And so we're all successful in our own right. We do totally different things in our careers, but we're all successful. But I did not realize till the other day, I'm the first entrepreneur in my family. And so when it goes back to what you were taught, what you lacked, what you didn't have, that type thing, you can't dwell on because a lot of people will say, well, I didn't learn this from my mom and dad, or my dad wasn't there to teach me this, or my mom wasn't there to teach me that. But there are so many people in the community that are there, lenders. That's a lender is a part of a community that teaches you how to invest in yourself. You may not be ready to buy a house today, but that lender will prepare you for tomorrow when you're ready to buy that house. I truly believe that. And so if you never call and you never ask the questions that you didn't have mom and daddy to teach you, if I would have went on what my mom and dad and my grandparents taught me, I would have been a teacher. Okay? I would have been a principal. Not saying that those are not great jobs, they are, but it wasn't for me. My brother and sister made great careers out at the plant. My brother's a supervisor. My sister just retired at 57 years old with full points of 32 years service, and she's living Gucci, okay? But that wasn't the plan for me. and I was supposed to be an entrepreneur, and I love being an entrepreneur, but it's not made for everybody. So reason why I'm saying that is to say is get connected with people like a Chris Webb that is willing to tell you, his struggles that he's had in his past on different things, and tell you exactly what you need to do to make sure that you're financially sound. Chris is really good with first-time home buyers. He is humble, and he doesn't talk above your situation. That's one good thing I'll say is that Chris is humble enough to know, what, he is very successful, but he knows where he started. He knows the struggles that he's went through. He's not on, he's not in his first house. So he's bought houses, but he knows there's been struggles leading up to that. So he's not going to judge you like you would think a lender would do. They don't look down on you. And if I can tell you anything about a lender is if you got a lender that is talking down to you, you don't need that lender. You need someone that is going to really talk to you just like y'all on the same level. And I can honestly say, Chris, I've never had a client ever tell me that you've talked down to them. Ever.
No, that wouldn't be cool. And I definitely don't do that. And, I wasn't always the most responsible guy. I wasn't always the guy that put a lot of emphasis on trying to do the right thing and pay my bills and all that. So, no judgment passed there. And I would just encourage people that, even if you're not ready to buy a house today or even in the next few months, there's nothing wrong with calling up a lender and developing a rapport, asking questions, and saying, hey, I'm not ready to buy right now. That's probably a year down the road, or heck, it may be longer than that. But that's fine. We got time. That's what we do. We're usually happy to give advice and do what we can to start to develop a relationship with you.
Correct.
Just, it's a new contact. It might be even a new friend, and it's probably going to be business for us down the road, whether it's 5 years from now. That's fine. I love it when people call me and take the initiative to call me and just say, I'm not ready to buy yet, not ready to get approved yet, but I do have some questions and I want to get prepared.
And a lot of people, I'll tell you, when people say, well, I'm not ready to buy yet, they may think that they're not ready to buy, but after you've talked to a lender, I've had many clients that say, well, I didn't even think I was ready yet. But they're so excited after they talk to the lender that they think that they're so far off of the time when they're truly ready to buy a house. And they find out after they talk to the lender, well, I'm not that far behind. And then I've had clients that say, I got pre-approved. Oh my gosh, I cannot believe this. But they were the ones that thought they wasn't ready. But it took the lender to say, no, you really are financially sound. You're more financially sound than you think you are. So that's why I think that you should always go to a lender. I want to talk about one more thing before we get off of here is down payment. Mm-hmm. In these days and times with everything being so expensive, food, gas, you name it, everything, clothing, everything's expensive. So many people are worried about down payment. Now, let me first say, Chris probably won't say this, but I will say this. I truly tell people not to go for 100% loans if you can. Reason why? Because I think it's a bad investment. If you don't have any skin in the game, if you have not put any money down on your house, that means you're going into a house with no equity. And I like my clients to have a positive going into a house than a neutral or negative, that type thing. And a negative is when you haven't put any money down, you have no equity. And so will you touch on what is out there down payment wise? You can even talk about the 100% loans, but I just wanted to put that disclaimer in there.
Sure. Well, so that's that's for people that are renting and looking at potentially purchasing their first house. Down payment's a very real, concern. And so how much do we have to put down? And that is going to be dictated by your credit and your credit score. It's going to be dictated geographically. Yes. Where are you wanting to purchase?
Correct.
Because there are different programs for different people in different, parts of America. For instance, if you are thinking that you don't necessarily want to buy. We're in Knoxville, right? So you don't really want to buy right in Knoxville proper. You don't mind being out a little ways.
In the county or
In the
something.
county or, yeah. There are some incredible loan products out that are available out in the county, so to speak, that don't require any down payment. And those terms are really, really good.
And for people that thinks that houses, people are like, well, I don't want to be in the county. There are beautiful homes in the county, and I don't want to be just out from the city or whatever. The county is not just out in rural areas, okay? There are a lot of homes in the county that you can get to an interstate or grocery store or pharmacy or whatever, in 5 to 10 minutes. So don't look at the county as being rural area.
Yeah, we're not talking about out in the boonies.
Yes, we're not talking about.
We're talking about, in some cases, 3 or 4 minutes from humongous busy intersections with all the great department stores and grocery stores and everything. So
beautiful homes in Powell. There's beautiful homes in the county in the south Knoxville. There's beautiful homes in East Knoxville, Carnes area. Believe it or not, I live in West Knoxville. I live in the county, and I live right off Kingston Pike. Okay, so county is not in the boonies. It's really not. You just have to figure out where the county lies. Keep going on the down payment.
So you can also get 100% financing in the middle of the city. It's worth mentioning that. The state of Tennessee has a program that I won't go into too many details, but it simply allows you to make a purchase without a down payment. There's some drawbacks to it, but there's some positive to it as well.
It's called THDA.
Right.
THDA.
Right.
Keep going.
But I think it's important for people to understand you don't have to figure it all out and then go to somebody that maybe you're afraid or you fear they're going to, like you mentioned it earlier, they're going to look down on you or look at you like you're stupid. I mean, as lenders, we are lenders, but we're really advisors.
Yes.
And it's our job for you to bring a puzzle to me, right? If it's me, you're going to bring me this puzzle, and the puzzle is you. And I got to figure out based on, this and this and this, how we can put this puzzle together and make you a homeowner if you're a first-time home buyer. And that's really what a good lender is. They're a friend, they're an advisor. They're not looking down on you. Don't be intimidated by lenders. 9 out of 10 lenders are great people.
Yes.
There to help. And just so often people have told me I was scared to death coming in here, Chris. And I'm leaving with a whole different perspective.
I'll tell you, even people that have bought a home before, but say, I had one client recently that she hadn't bought a home in 20 years. And what lenders were 20 years ago versus now is so different. And so the things that they didn't ask for back then, they ask for now. And things that, some of the things that they ask for now, it made more sense to her. And she she's like, oh, wow, this just opened me up to something else. It made her think of other investments that she can do, but she'd already owned a house. So most people think, oh, well, I already own the house. I already know where it goes. Let me tell you this, and Chris will tell you the same thing, is if you bought a house 3 to 5 years ago, what buyers are going through right now is totally different. So don't take advice from somebody that bought a house 3 to 5 years ago in a totally different market. Totally different. It will not apply to buyers today. Do you agree or disagree?
Yeah, all the time.
I mean, because so many people compare their finances and their situation to someone that has already bought a home or owned a home before, whatever, but you're not getting the same terms. That's why I tell you, go find out what your terms are. There's so many programs out here. There's FHA out here. There's conventional out here. There's THDA. There's rural housing. And all of them, their terms are different. All of those loans are different. What is the lowest down payment out there right now besides the 100%?
Well, a conventional loan can be done at 3% down.
Okay.
FHA loans are 3.5% down.
Okay.
So, there's a lot of great loans out there for little to no down payment.
Yes. I think you should put down some money though. That type thing. And if it's a situation that you can't, just know that the more money you put down on the housing side of it, even a seller is going to look at, whatever financing that you're getting on their home. And it may determine to them if they're going to accept your offer or not, because the terms of whatever that loan may not meet up with the seller. So if you get 100% loan, they know there's other things that may have to be fixed on that home that they're not willing to fix. Okay, so you're looking at just your finances, but the seller's going to look at their finances and what they're needing to do. And most sellers are going to take a FHA buyer or conventional buyer way faster than they will take a rural housing. And I hate to say it, but even a VA buyer, it's sad that I saw many VA buyers get, lost bids because of what financing that they were going for. So ask your lender the ins and outs. Okay, is this the only financing I can get? So that when you get with your realtor, you can say, I got approved with these two different terms. Now, what's the best for me to get my dream house? Do you agree? To
get an accepted offer by the seller in a competitive market.
Because a seller doesn't go off of what you want it to be. They're going off of what their financial goals need to be. So keep that in mind. But if you go to Chris Webb, Chris understands both sides of it because we talk about real estate a lot. And then he has other realtors that he talks with and does business with that he knows the market very well. Chris, tell them how they can get in touch with you.
You can get in touch with me by giving me a call at really any time. My direct line at the office is 865-297-4613. I don't mind giving my cell phone if somebody wants to reach out to me directly. It's 865-384-7291.
And where is Gateway located?
The office address is 9145 Cross Park Drive, right off the Cedar Bluff exit.
That's perfect. So I highly recommend you reaching out to Chris, getting pre-approved. Call the Landes girls always for your real estate needs. We'll help you find your home in East Tennessee. And tune in every Friday at 4 for the download of Talking Tennessee with Yvonnca. We tackle so many different topics, from real estate to love to, hey, your life journey. Tune in. Bye, guys.
Thanks for listening to Talkin' Tennessee with Yvonnca. Watch out for our weekly episodes from the First Family of Real Estate. And check us out on the web, www.yvoncasalesrealestate.com. See our videos on Yvonca's YouTube channel or find us on Facebook under Yvonnca Landes and Twitter at Yvonnca Landes. And don't forget to tell a friend about us. Until next time, Yvonnca signing off.